As financial planners, one of the most important things we need to do for our clients is to develop an investment strategy that has a high chance of achieving their goals. This probably sounds really simple, but we often find that people really struggle to articulate why they hold the investments they do. The link between what people are trying to achieve and the way they are actually investing is often pretty loose. I think one of the key problems is that we usually want our investments to achieve a lot of different things and all at once. Nobody really wants to lose money, but we want to make money too. And yet, we all know that chasing higher returns inevitably comes with a greater chance of losing money. So most people's portfolios end up as a compromise, somewhere along this scale from low risk and low return to high risk and high return. Where people are invested on this scale is usually based on the results of a risk profiling questionnaire. This is a test that works out your tolerance for investment loss. If you've tested as having a low tolerance for loss, chances are you'll have been given a low risk, low return portfolio. The problem is, what if this portfolio won't achieve your goals? There are three key problems we generally find with these one-size-fits-all portfolios. The first key issue we look at is cash flow. If you're retired, it's vital that there's enough money in your bank account each month so you don't need to worry about how you're going to cover your living expenses. If you're not retired, you might be investing partly to meet a goal like buying a house or a car. Either way, the money has to be there when you need it. And yet, with many portfolios, there isn't enough cash to meet these requirements. For example, people might be relying on income yields which are rapidly falling, or they might have too much allocated to higher risk investments like shares. In both cases, it means you could be forced to sell investments to top up your bank balance, even if it's a down market and it means crystallising losses at the worst possible time. Another common issue is longevity. We might run out of money before we run out of life. They're talking about 100 years now as a realistic life expectancy for many of us. That could mean 40 years in retirement. This means our assets must deliver a reasonable rate of return over time if they're to last that long. And yet we see many people with very high allocations to conservative investments, like cash and term deposits. Particularly since the GFC, some people have become gun-shy and they're unwilling to run any risk of losing money. But holding assets that will barely outpace inflation pretty much ensures that you will run out of money. This last one is an often forgotten but really important issue. Too often we build a strategy assuming that everything will go to plan. But what if there's another global financial crisis? Or you or a family member gets divorced, you lose your job, your business heads south, or you need to help a family member in crisis. It's important that your assets aren't locked up and your plan is resilient so it can cope with the unexpected setbacks. So, how do we build an investment strategy that can help you achieve your goals without running into these problems? Well, rather than trying to construct one single strategy that tries to do everything at once, we separate your investments into 4 different strategies. We call them buckets. Each of these buckets has a different goal to achieve. This way, you can clearly see which of your investments are helping you to achieve each of your goals. Our starting point is the time frame in which you want to achieve your goals. We call the first bucket the foundation bucket. This is where you put all your investments that are going to help you achieve your short-term goals. For most people, we look at the next 3 years. Because it's vital that the money actually be there when you need it, this bucket includes only very conservative investments, which have very little to zero risk of capital loss, like cash and term deposits. But as I mentioned before, most of us need at least some of our money to be working a bit harder than this. So that's where the next bucket comes in. The preservation bucket is for money that you probably won't need to access for at least 3 years. although capital protection is still important, you would still like to see it earning a reasonable return in excess of inflation. Because you probably won't need this money for a while, you can ride out a bit of the short-term volatility, so we can include some investments in this bucket that have a higher growth potential than cash, such as fixed income or even some carefully selected shares. For some clients, this may be enough. If your goals are modest and you prefer a low-risk portfolio, a combination of investments in these two buckets might get you to where you want to go. However, the truth is that many of us have more ambitious goals than this and need some more of our money earning a bit more. The accumulation bucket is where we group investments that are aiming for a much higher return over inflation. Because these sorts of investments, such as shares, tend to have a higher risk of capital loss in the short term, it's important that this bucket only includes money that you're unlikely to need for at least the next 6 years. With that time frame in mind, we can look for investments that have a higher probability of delivering a good return over the long term, even if that comes with higher risk. Because your short and medium term needs are already covered with the more conservatively invested funds, you can afford to take some more risk with this money. This gives you the chance to achieve those higher returns you're looking for. Most of our clients can achieve all that they're looking for with a combination of money in these three buckets. However, if you have excess funds remaining after your core objectives are met, and you have a pretty good understanding of investments, and are prepared to take much higher risks, we can offer some unique investment opportunities. This is the acceleration bucket, and it is absolutely not for everyone. These are unique, one-off investments that can't be included in a standard portfolio. For example, they might require your capital to be tied up for a number of years, or the risk return might be very uncertain. Examples include private equity, large single property investments, micro-cap shares, and so on. Because the chance of loss with these investments is much higher, we will only present these ideas to selected investors, and only after we're confident you have sufficient funds invested elsewhere to meet your core needs. The next step in the process is to work out how much you need to allocate to each bucket in order to meet your goals. For this, we use the Profile Pathways modelling tool. I explain this tool in more detail in some separate videos on this website. Thanks for your time.